Hi, this is Brian with the first quarter 2022 update. And remember, at Leelyn Smith, we try to reach client goals with the least amount of risk possible. We're starting a new tradition this year. This is a market outlook video. We'll do this from every year from here on out. And the idea is to help our clients try to set expectations for the year. So let's dive in. The first item to address is the business cycle and where we are in the business cycle. Right now, we are in the mid to late mid phase of the business cycle. And in that phase of the business cycle, we typically see rising and higher inflation. And of course, that's all over the news right now, and you've probably heard about this. And in an increasing inflationary environment, you typically have a Federal Reserve or a central bank that wants to increase interest rates. And the reason behind that is that the Federal Reserve doesn't want inflation to get out of control and too high, because then prices would get out of control and there'll be a major impact on the economy. And the biggest weapon they have to fight inflation is interest rates. Now, an increase or a decrease or just any change of interest rates has a relatively strong impact in the economy. Number one, an increase in interest rates will increase bond yields. And that sort of sets everything in motion. As bond yields increase, bond prices drop, and it also becomes more expensive for all of us to borrow. So mortgage rates go up, auto rates go up, loans that companies use to increase their businesses, to grow their businesses, become more expensive. And in that phase, in that sort of structure of the economy, that's how stocks are impacted by an increase in interest rates. Because as these companies are growing their company, and the loans that they're taking on in order to grow the company, as they get higher, these companies, all things being equal, they now have to pay out more in their borrowing rates than they previously did, which has an impact on their earnings, or i.e. profits. So now they're paying out more of their profits into borrowing rates, and that therefore, in theory, decreases their value. And as we try to determine where stocks will be years from now, we use interest rates to model out and project where stocks may be. That being said, the consensus this year is 4 quarter-point interest rate hikes. We think it'll be 3 because we think the Federal Reserve will take the midterm election cycle off and not increase rates then. And then the other side of the fence on stocks, the consensus is for a 9% earnings growth rate. That seems pretty reasonable to us. That doesn't mean stocks will be up 9%. That just means that's the expected earnings growth rate of stocks. And remember, over the long term, earnings determine stock prices. But in the short term, there are a lot of other elements that can increase and decrease prices, send them up and down. Then that's called noise on this side of the fence. So to summarize, we will have an increasing interest rate environment due to increasing inflation. We do still see, Wall Street sees stocks as growing by 9% in general. Now that's on the S&P 500. That doesn't mean prices will follow that. That means that's what they're expecting. And then lastly, we're in the mid to late cycle of the business phase. And it appears we're going to stay there for another year or two, maybe a little bit longer, and have a more maturing and slower growing economy from here. Okay, that's it for this time. Thanks for watching. And remember, at Leelyn Smith, we try to reach client goals with the least amount of risk possible. Thanks for watching.